Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video we are going to analyze Twitter. We're going to use a little bit of technical analysis and we are going to see what is going on. Now first of all, if we went to the long term, this is a 5-year chart. There's really nothing, and I apologize for this. I am doing the free version of TradingView. TradingView is a great charting website. It is a great platform and I really like it. At some point I am going to sign up, but for now it's free, so you have to bear with me with these ads. So anyways, back to what I was saying. In the 5-year chart, there's really nothing going on here. This is just a meaningless line. It goes down and then it goes up, and who the heck knows what Twitter is going to do based on all of this scribbling, right? If we shrink it down to a year, same thing. It's just a line. It goes up and then it goes down, and who the heck knows what Twitter is going to do based on this chart. There's no charting, no trend analysis you can do on this. Now if we go down to a month, now we're talking. Now this is something that we can actually work with. Okay, now first thing that I want to show you is this little part right there. That was earnings, okay, and Twitter went down from this level right there all the way down to this level, right? It took a big plunge, and so we are not going to worry about what happened before this earnings. We are going to chart from this point to this point. Okay, so let me delete all that out and let me draw a couple of trend lines. So the first one that we're going to put is right there, and then we're going to draw a lower trend line to right there, and that's our resistance level. Now we're going to draw a lower line, and we are going to start from right here and we're going to go down to here. Okay, and this is what it's been doing since the last earnings. This is something that we can work with. This is called technical analysis, and we can work with this. Let's scooch this over a little bit and just isolate this part a little bit. Okay, so what we see here is a channel. Okay, this upper line here, that's the resistance, and this lower line is the support. So if we keep going by this pattern, then what should happen is this right here. If the pattern continues, it will just keep going down like that, and the lower will keep going down as well, right? So that's what should happen. Now let's go to my account and let me show you what I got here. Okay, so here I have a $30 long call, and here, and this is the important part, is I sold to open a $29 call, and it expires Friday. Okay, now first of all, in my overall position, I bought this call on September the 10th. I spent $777, and I've made $100 on premium by selling to open call options weeklies, and both times I made money. Here's the proof right here. These are my transactions. So there's the $777. Sold to open a $30.50 call, took in $50.29, bought it back for $3, so made $47 there. Sold another one for $48.29, and I just let the darn thing expire all the way to zero, so that's $96 that I made. And so this $29 call that I sold to open, now I'm able to sell that with zero risk, because if Twitter goes up, yes, it is $1 lower than $30. Yes, I will lose $100 in intrinsic value, but I made $100 in premium, so that cancels out the risk, and this is just extra gravy, right? So no risk for me there. But back to the call option that I sold. This expires on Friday at the $29 level. So let's go back to our chart here and let's take a look at something. So today is September the 26th. The market opens in about 4 hours, and let's take a look at what might happen, or what logically should happen, if Twitter continues to follow this pattern. Okay, so I'm going to draw another trend line here. Actually, I'm going to have to do a reset. Okay, here's the second trend line. Now let me put up my drawing tool and let's go to September the 28th. That will be Friday. Today is Wednesday. So we go down to September the 28th, and this right here is right where the market should close. So if we end the drawing right there and then we move over, right, it looks like Twitter should be at about $28.60, give or take a few pennies. So what does that mean? Going back to my account here, let me get rid of this stupid ad. Going back to my account, that means that this contract, which right now is worth $50, will go all the way down to $0. And again, if we go to my transactions, you can see that I originally got $28.29. So I'm actually down on that short, but I am up on my long call, right? And that's why you can see that for the day I'm actually up overall $23.33. So once again, no risk on the upside. My biggest risk is on the downside. If Twitter were for some crazy reason to go down to $25, then my long call would lose value. It would probably go down about $200 depending upon what the delta is, and I would make this call option would go to zero, and I would make the full premium that I originally got when I opened the contract, which is $28.29. So this right here is a little example on how you can use technical analysis to determine how safe is your position. And right now, if this is called a channel, and if Twitter keeps it up, then I should make the full premium, and then I can just sell to open another weekly option, and I'll probably keep doing lower strike price options at the safe level. So that's it for this video. We will see what happens in the coming weeks, and if you have any comments, or questions, feel free to leave in the comments. Thank you for watching, and I will see you in the next video.